Welcome to our Financial Accounting B group presentation. My name is Joss, accompanied by group members Lucas, Khung, John and Satvik. I'm going to explain in details the terms impression management and earnings restatements. Impression management is a conscious or subconscious process in which people attempt to influence the perceptions of other people about a person, object or event. This is done by regulating and controlling the information in social interaction. In the context of corporate reporting, impression management occurs when management select information that distorts readers' perceptions of corporate achievements. Companies may entail enhancing desirable aspects to form a positive construction of public impression to various stakeholders. Alternatively, an organisation may bewilder less desirable aspects, thus attempting to manipulate organisational audience perceptions. Managers can achieve this through either financial statements, such as earnings management, or corporate narrative documents, such as press releases, websites, or annual reports. On the other hand, restatements are the revision and publication of a company's previous financial statements when it's determined that there's a material inaccuracy in previous statements. Earnings restatements can be corrections in financial statements, but they can also help investors get a comparative sense of how a company is performing without a recently divested asset, with a change in accounting method or with some other significant change in operations. Studies have shown that impression management and earnings management are complementary disclosure practices jointly used to manipulate the perception of outsiders about corporate performance. I'd now like to pass over to Lucas, who will talk about why managers engage in earnings restatements.
So when attempting to answer the question of why managers engage in earnings restatement, it's firstly important to not blur the distinction between why managers manage earnings in the first place and why they subsequently engage in earnings restatements. However, the concepts are inextricably linked, as restatements wouldn't occur without initial earnings management. So moving on to the reasons for earnings management, and a paper published by Ditchev and Skinner looks at the use of accounting covenants within private contracts that ensure firms maintain a certain level of earnings. So the argument is that managers are motivated to increase earnings through fear of contravention. Furthermore, a paper by Richardson, Tuna and Wu looked at heightened capital market pressure as another reason for earnings management. There are a number of other reasons, including the need for financing to cover high levels of debt, increasing earnings for better credit rating, or inflating earnings to raise stock price. So why do managers engage in earnings restatements? It could simply be because they are forced into doing so. A paper published by Flanagan and others describes how the Securities and Exchange Commission, or the SEC, is a major player in the restatements in US firms. The SEC has the ability to initiate formal and informal letters, as well as potentially launching investigations into earnings restatement cases and prosecuting individuals and companies. The bottom line is that managers engage in restatements because they have no real alternative but to do so. Another reason is that managers engage in restatements because there has been a number of accounting or clerical errors that resulted in wrong information being published. And so the managers feel a sense of duty to go back and provide a restatement that reflects the company's true position. However, it might be naive to think that this is the case due to the amount of scrutiny that reports come under at the end of the year in terms of auditing and company checks. And I'll pass on to John, Satvik and Khung, who will talk about the company General Electric.
Hi, welcome to Part C with me, Satvik and Khung, and we're going to be talking about the General Electric's recent earnings restatements in 2018. These earnings restatements came about after a new accounting standards of when to recognise revenue of long-term contracts. This was after the US Securities and Exchange Commissions investigated them specifically on this issue after they were recognising revenue from long-term contracts long before they provided the service. These earnings restatements have proved to be very controversial among investors and shareholders, particularly as the company has been struggling for a while and faced multiple other challenges that will worsen how they will be perceived, especially if these restated earnings will worsen their credit rating. They have faced steep declines in their power and transportation business, and they currently face legal action by the US Department of Justice for violating US law with subprime mortgages. Briefly, with the media coverage on General Electric has been very negative and highlights all these problems that the company faces. This has directly impacted on how General Electric used impression management in 2018 annual report. From the media coverage, it's obvious that General Electric needs to convey that there's a positive future ahead and will need to use impression management to do this. I will now use Klosky's two-component model to explain what will motivate General Electric to use impression management and how they construct it. Briefly, what will motivate General Electric to use impression management. One of the main goals of the company is to maximize shareholder wealth and to keep them happy with long stable dividend payments, all of which has decreased recently. Therefore, General Electric will want to give the impression that they are doing all they can to improve the financial situation to meet this goal. Another major goal is to keep the customers and American public happy with the performance due to the nature of the business being a public utility company. There's also a large discrepancy between how it desires to be perceived and its current image, as shown by the media coverage. They need to address this, and by using impression management, the new director needs to get back a positive image of the management and the company. This is important as how investors view the performance and vision of the business directly affects the share price of General Electric, and therefore will affect shareholder wealth. Now on to impression construction and self-concept. Most people value certain aspects of themselves, and they proudly display to others at appropriate times. Impression management often involves an attempt to put the best parts of oneself into public view. This can be seen in the 2018 annual report. These networks will continue to be our unique competitive advantage, and we pursue profitable cash-generating growth for many years to come. Secondly, in self-concept, organisations are constrained by what information people have about them, and therefore are mindful of the fact that they can only successfully foster particular impressions with the constraints of the information others have about them, as shown by the negative media coverage. This means they hesitate to claim images that are inconsistent with how people actually see themselves, and won't go for an image they know they can't pull off. And so General Electric, in its annual report, accepted this and have accepted the bad press performance in recent years, and has tried to address this with positive comments. For example, they used the phrase, "This is a game of inches every day, not feet or miles," and said that we face a number of hurdles, but the entire team of General Electric is focused on tackling our issues head on and making progress across multiple metrics. And finally, desired and undesired identity. The second point in impression construction I want to raise. What a person would like to be perceived and what they can actually perceive, and the best impression they can give off. People tend to convey impressions that are biased towards the direction of their desired identities. People can develop desired identities by publicly claiming attributes that are consistent with those identities. Organisations seem to strike a balance between presenting themselves in a perfectly candid fashion and claiming images that only portray them at their best. And this can be shown in their 2018 annual report by saying that they're up for the fight and ready to win because General Electric matters. And this contrasts with the current perception of General Electric management that is poorly managed, slow-moving, stagnant, and lacks drive. Now I'll move on to Satvik.
Hi, I'm going to talk about Irving Goffman, the presentation of Self in Everyday Life, 1956, and how this relates to GE's impression management. And yeah, according to him, every performance has certain aspects that manage the actor's impression in front of the audience. And I'm going to talk about these aspects in relation to GE's annual report from 2018 and the disclosure notes of the CEO. Belief. So throughout the annual report, the CEO tries to portray GE as a team of employees from bottom to top, which leads to eventual success. The new CEO, which was one of the latest appointments of the board of directors from GE, seems to be a better execution for the company in the future. Then comes mystification. The annual report does not mention the change in accounting laws that initially led to profit restatement. This was a change in the accounting treatments for long-term contracts, which led to a reduction in the annual profits of 2016 by 220 million and 2017 by 2.2 billion. And then comes dramatic realization. The CEO dramatizes the process of GE's growth over the next decade and tries for the shareholders to feel a part of the process by conveying their own disinvest. Also, the annual report involves dressed up revenue figures in 2018 to show results to the shareholders and promise a better future for the company by starting from power and focusing primarily on their financial position. Idealization. The annual report tries to give the company a reputation of a customer-oriented brand, as it is a national utility company. Along with that, Mr. Lawrence Cobb, the CEO, promises a successful and highly eco-friendly future for the company with a strengthened financial position. That's a very ideal view of the company. So a couple more aspects of performance are in character and misinterpretation. Misinterpretation. So the annual report started off with promising a better future and immediately shifts to counting the successes to keep the shareholders hooked. Towards the end, there are slight mentions about the mistakes of the past, keeping the objective of the report simple and clear though, that is, GE is a long-lasting and a successful business corporation.
There are two general approaches to manipulating financial statements, one of which is by exaggerating current period earnings on the income statement by artificially inflating revenue and gains or by deflating current period expenses. This approach makes the financial position of the company look better than it actually is in order to meet established expectations. The second approach does the exact opposite. It may seem counterintuitive to make the financial condition of the company look worse than it actually is, but there are many reasons to do so, such as to dissuade potential acquirers or to postpone good financial information to a future period when it is more likely to be recognized. When it comes to self-disclosure, there are numerous accounting techniques at a company's disposal, such as the recording of fictitious revenue, recording of revenue prematurely or of questionable quality, and the failure to record or improperly reduce liabilities. General Electric, like a professional athlete revealed to have been dabbling in steroids, has prolonged a near-decade-long record of meeting or exceeding analysts' expectations by resorting to tricks including selling locomotives to financial institutions in transactions that looked a lot like loans and fiddling with the accounting for interest rate hedges. Accounting standards for long-term contracts mean that reported revenues do not have to follow customers' billings. Only amid a Securities and Exchange Commission inquiry did General Electric begin reporting the difference between the two in the notes in its accounts, which divulged that it recorded revenues that were 3.5 billion greater than its customer billings in 2017. General Electric argued that the increase was primarily driven by a change in estimated profitability for its long-term service contracts. However, there was a similar excess of revenues above billings of 2.6 billion in the year before. Coincidentally, it was forced to take on an almost equal figure of 6.2 billion after-tax charge to cover liabilities on insurance policies, a business that it put out in 2006. Nevertheless, the US Financial Accounting Standards published an update to accounting standards in 2014 with effect from 2018, supposedly bringing US generally accepted accounting principles into line with international reporting standards, which have also been revised and provide more useful information to users of financial statements through improved disclosure requirements. The earnings restatements of General Electric in 2016 and 17, when conforming with all new standards, resulted in a 9% and 15% reduction, respectively, for adjusted operating earnings per share upon adopting the new accounting standard for recognizing revenue from long-term contracts.
So to conclude, we have defined the terms impressions management and earnings restatements. We have looked at why managers engage in earnings restatements. and we've used Kowalski's two-component model as well as Goffman's techniques of impression management to explain how General Electric have engaged in impressions management. Thank you for listening.